that there's no solution to the U.S. government debt short of bringing to the table 300,000 tons of gold. Let me repeat that. $34 trillion is about 300,000 tons of gold. Unless that happens, we've got a threat of embargo, we got a threat of depression, we got a threat of huge hyperinflation, we got a threat of massive shortages.
In today's news roundup, gold fluctuations. Based on our gold return attribution model, the key factor behind gold's downturn was a robust surge in the U.S. dollar index, which concluded the year at its peak. Mitigating gold's decline were an uptick in break-even inflation forecasts and the geopolitical risk index, likely fueled by the imposition of martial law in South Korea, as well as modest global gold ETF inflows. Global gold ETFs managed a U.S. $778 million rise in inflows, driven by strong Asian ETF acquisitions, significantly counterbalancing outflows in North America. During December, those outflows were relatively mild, considering the weakness in November and the likelihood of profit-taking after such a stellar year. An optimistic sell-side forecast for gold likely helped limit a larger end-of-year shift away from gold. Bonds are likely to remain volatile, and this could support gold to a minor extent. In the short term, gold might need to stabilize in Q1 2025, as technical indicators suggest it is positioned in overbought territory. Additionally, the Fed has put the punch bowl back on ice. A 25 basis points Fed policy rate reduction in December, along with further hawkish messaging, caused notable intraday fluctuations in equities, U.S. Treasuries, and gold. The S&P 500 declined by 3%, and the 10-year Treasury yield registered the most significant FOMC meeting move since 2013. Gold fell by over 2%. Clearly, the Fed's cautious tone encouraged some investors to lock in profits following an exceptional year for equities and gold, with tax loss selling providing further motivation to reduce equity holdings. A high level of uncertainty. The response likely also stemmed from some pent-up uncertainty, as markets and the Fed prepare for a leadership transition at the head of the U.S. economy on January 20th. While FOMC members are fairly confident about where interest rates will stand at the end of 2025, they are unusually split on where rates will settle at the conclusion of this rate-cutting cycle. Enjoy the episode.
We're going to see some shockwaves, and it's going to be interesting. One of the shockwaves coming, and real soon, Jesse, is countries and companies want to bring their subsidiaries and invest in the United States, but we don't have an adequate skilled labor force, short of 300,000 tons. Remember, Fort Knox was a little under 10,000. So we're talking about 300 times Fort Knox's. More than that. There is a possibility that something like that might happen. And it could be Philippine gold. I have 2 or 3 different contacts who've let it be known to me that Philippines has 1.3 million tons of gold and it's being hidden. But here's a weird phenomenon, Jesse, and this is, you got to get practical when you're talking about political solutions. It could be that we're going to see Gresham's law come to the table, come to the fore. The best money will be held back, and the poor quality money will be brought forward. In other words, if you've got treasury bonds and you want to redeem them, well, we've got cash and we'll print it. We'll print some money for you. That's the lowest quality money. And if you reject that, well, maybe we'll offer you some resources like, super tankers of oil. And there was a phenomenon over a year ago. There were 20 super tankers parked at U.S. ports, and they're all loading up. And a colleague of mine said, Jim, they're getting credits for imports. The U.S. is now getting credits for imports by loading up oil super tankers, and it will not last long, and it will not be sufficient. we're getting to the point where we can't pay for our imports and we don't have sufficient industry, and we can't reindustrialize because we don't have sufficient skilled labor. This is going to get very ugly, very dicey, very fast.
In today's news summary, silver prices soar to nearly $29.50 due to heightened safe haven appeal. Silver continues its upward momentum for the third consecutive day, trading near $29.60 per troy ounce during the Asian session on Friday. This ongoing surge is driven by robust safe haven demand amid enduring geopolitical conflicts in the Middle East and the prolonged Russia-Ukraine war. Axios cited 3 sources suggesting that U.S. President Joe Biden allegedly explored backup plans to strike Iran's nuclear sites if Tehran made significant progress in developing a nuclear weapon before Donald Trump's inauguration on January 20th. These discussions highlight escalating concerns about Iran's nuclear ambitions during the shift between administrations. A report by the Financial Times stated that the People's Bank of China, PBOC, is forecasting an interest rate reduction this year at an opportune moment. Market participants are closely observing the potential rebound in China's economy and its implications for industrial silver demand. On Tuesday, President Xi Jinping reaffirmed his pledge to prioritize economic expansion, committing to more assertive policies to strengthen China's economy in 2025. Although China's manufacturing activity exhibited limited growth in December, the services and construction sectors have rebounded. The data reflects that policy measures are beginning to affect specific sectors as China braces for new trade challenges arising from tariffs proposed by U.S. President-elect Donald Trump. Enjoy the episode.
And he says that the foreign nations holding treasury bonds will redeem them with the U.S. Treasury Department. And the Treasury Department will hand them coupons. And the coupons will be valid to buy stocks and bonds in the United States financial markets. And that will, I think, coincide with the capitalization of new industries, plant, and equipment. Okay, but when you talk about new industries and the financing and plant and equipment, what are you lacking? What's missing? A labor force. I'm telling you, we're going to have a problem with our labor force. It's not going to be a problem with bringing back, say, the auto workers to reinvigorated plants that get a little retooling and take 3 to 6 months for some retooling. No, that's not going to be the problem with the big 3, Chrysler, Ford, General Motors. That's not going to be a problem for them. They're going to be happy to do it. They're going to be happy to move it back from Mexico. The problem is going to be the new entries. And many of the new entries are going to want to focus on the hot industries like artificial intelligence, robotics. So we may get, Jesse, this is ugly stuff. We may get new industries coming in that build robotics that wipe out American jobs. Oh my gosh, this is going to get very complicated. And, you know, this is going to be an ongoing topic of study. I would like to see some of the basic industries, and I've outlined some of them in my recently posted December report. I have a monthly report. I call it the hat trick letter just because there are 3 key parts to it. Just a name, but it's on golden-jackass.com. But I outlined that we need to bring back construction for housewares, you know, plates, glasses. You know, I recently bought a drying bin where you put plates and on the side your silverware. It's not made in the United States. It's made in China.
Dr. Jim Willie is a renowned economist with a deep understanding of global financial markets and a reputation for delivering thought-provoking insights into the world of economics and finance. Known for his independent and often unconventional analyses, Dr. Willie has spent decades studying and interpreting the intricate dynamics of global economies, with a particular focus on gold, silver, and the broader monetary system. At the core of his views lies the belief that the global financial system is undergoing a monumental shift. Dr. Willie often highlights the unsustainable nature of fiat currencies, particularly the US dollar, which he sees as being propped up by artificial mechanisms like excessive money printing and geopolitical manipulation. He emphasizes that this system cannot persist indefinitely and predicts a significant rebalancing in favor of hard assets such as gold and silver. Dr. Willie has consistently argued that gold and silver are the ultimate forms of wealth preservation in times of economic instability. He views precious metals not just as commodities, but as essential safeguards against the devaluation of paper currencies and systemic financial risks. He frequently points to the role of central banks and their covert operations in managing gold prices, asserting that these practices are designed to maintain the illusion of stability in fiat-based economies. Another critical aspect of his analysis involves global trade dynamics. Dr. Willie believes that we are witnessing the decline of the US dollar's dominance as the world reserve currency. He argues that nations like China, Russia, and others are steadily moving away from dollar-based trade systems, opting instead for alternative arrangements backed by tangible assets. According to him, this de-dollarization trend is accelerating the shift towards a new global financial order. Dr. Willie is also a vocal critic of mainstream financial policies, including the actions of the Federal Reserve. He often critiques their reliance on quantitative easing, low interest rates, and other tools that, in his view, merely delay the inevitable collapse of the current system. He warns that these policies create asset bubbles, increase wealth disparity, and lead to long-term economic distortions. In addition to his economic and financial analyses, Dr. Willie explores the interconnectedness of geopolitics and economics. He frequently discusses how political developments, such as sanctions, trade wars, and regional conflicts, influence global markets and contribute to the instability of the current system. Dr. Jim Willie's insights are valued for their depth and clarity, even when they challenge conventional wisdom. His commentary serves as a wake-up call for individuals, encouraging them to think critically about the future of the global economy and the measures they should take to protect their financial well-being.
Don't forget to like our video and subscribe to our channel. Your comments are very valuable to us. Please make a small comment.